All right, guys, what's going on? I'm doing a recap of what we did in the prop room today, and I will talk about the global macro. I mean, we had another just utter melt up today in equities, which we were on the long side. We're on the short side also. So I'm going to walk through what we did, and then just to add some value, I'll do a couple small teaching lessons. I had some questions on somebody messaged me about the sine waves versus well, he called it cyclical wave structure versus our pi cycle. I won't get into all the details on the pi, but there's lots of different cycles. I'll just touch on maybe some of the differences if that's helpful in this video. And then also global macro. I'll hit on that in the morning. But there's just a lot going on today. So the big lesson or the learning point that I wanted to go over was how you start with a small amount of risk and then the importance of adding to your winners. So I mean, I did about 1,800 a day just on the prop side, and a lot of you guys had another comma day, which means obviously you did more than a few $100s. And I think everybody's profitable every single day this week. And then I looked at some of the stats, and most of you guys, if not all of you guys, are running between 67% and 85% consistency per day. And then which that's huge. I mean, that most of professionals on Wall Street that try to directionally trade, it's a 97% fail rate. Or guys will have a good year because they're on the right side of something that's working for 6 months. Um, they'll have a good year, and then the next year they have zero, very little consistency because the dynamics changed or they don't really have a model or a process. So um, that's obviously key to what we do, and it's very cyclically driven. So let's just start with the NASDAQ. Let me switch over to my charts. Minimize me. Uh, so came in today. Like this is the daily chart of the Russell, and I'll touch on this tomorrow. Where I think we're in full on melt up mode into the end of the year. I mean, we've been saying that since we came into the fourth quarter that could be the case. Holding here the early of December has just set off this whole thing. So there's several reasons why machines have to chase, Wall Street has to chase performance, etc. But so we like to do pairs trades even when we're day trading. So we've been in a range trade for most of the week, and I highlighted that yesterday. And so when we actually came in this morning, I'll show you guys our executions in a second. But this is the way that I like to stick to the process. So visually, everything's the same. We don't come in looking at 10 new indicators. We don't come in listening to 10 new people. We just try to, there's a lot of power and repetition. So we stay with the process. And for me, a lot of that is visual, staying with the same charts. So this is what I have up, and this is kind of what these are the indicators I like, and this is what our team was using. We come in. This was the range trade, right? And then we ended up breaking out. This red line was the prior high. Um, this was this was this was actually kind of a lot of good back and forth this morning. I mean, it was a small range, so it wasn't worth a lot, but we did a lot of good moves. So um, we covered this lows here, we covered these lows here, and then I'll show you how we were short into a higher high, which directionally is on the wrong side, but then we covered, and then I ended up adding and getting uh, more long and heavier on the Nasdaq as we came up. You kind of see that over here. So what we were doing, what I call the art of this size, which is how you work a position matters. In addition to do you have the correct analysis? Do you have both between the trend and your cyclical timing? So there's there's cycles on every time frame. So how you start your trades, end your trades around the cycle, that is 80% of your timing and consistency. But then I can have both sides of the market on and be wrong on one, but work my position and actually end up being in a winner at the same time being long in the same direction, um, and have a winner there. That's just a matter of how you work your position sizing. So that's a lot what we do in our prop program, is working on that. But anyway, just to keep it simple, this is a 5-minute chart. All right, equidistance highs and lows. So I'm literally just selling with the top of the cycle. You can even use an RSI to help you with is something overbought. Um, we use a little bit higher time frame cycles, 15-minute and 30-minute cycles. And so those were high up here. They were getting low here. And what I was doing was just working the short side of the Russell because small caps have underperformed. And just getting inside. I mean, you can even see on the 1 minute how there was a lot of back and forth before the breakout. Right. You can even zoom in here. Like for example, we covered into these lows and I reshort this small bounce and even covered on this small 1 minute cycle. Boom, cover. Right. Reshort, cover. And at the same time, because we come in and we look at our trend, which was, you can see by what we call the bands here, we haven't violated trend for this entire move almost. And so we held this area. These aren't level specific. So a lot of technicians would say, "Oh man, my moving average is broken, or the price is dipping below my moving average," so they want to flip and get bearish. That's one of the worst ways to manage risk around a moving average. We treat these as areas. So like a chain link fence, you can push up against the fence, right? Or the ropes in a boxing ring, you can lean up against them. So you treat these as areas. You don't panic and start hitting bids just because you get below that specific area. So this is the reason why we were long this morning, playing this pullback. 30-minute cycle was, it came in and it was on its way down, but it was getting towards the end of its cycle. And then the 15-minute, you notice how the bands are laying on top of each other. That's more indicative of a range trade. But again, we're buying into these lows. And then we work this position, adding and reducing really well for the entire morning. And so, but what I wanted to hit on, and you could start this trade with one contract, two contracts, keep your risk between $300 and $500. And if you add to your positions in the right manner, you end up doing 3x, 5x, 10x what your initial risk amount is. And that's the key. You can work into a position in a methodical way, not blindly adding to your losers just because you're fighting it, you don't want to be wrong. But then once it starts to move in your direction, that's you want to be able to add into the play in the right fashion. So that's what I teach. So we bought the dip. Okay, this is what we call a real money candle. My traders know why we call it that. This shows you the power this morning. This was the igniting bar that started this whole move today. Well, at least the move in the morning, and then this bar set you off, and then so did this one. All right. I'll sharing my whole screen. I'm gonna switch this over, guys, just to make sure everybody's getting it. All right. Lost my train of thought. Okay, so inside this bar, there's a lot of work to do. So let me bring up some of the execution. Oh, I'll do that after I explain. So this is the igniting bar. Now inside of this play, there's a lot of lessons in here. This is a lot of free lessons on how we trade. Boom. There's a wall concept I teach my traders. All right. This this is a wall that the bulls build. And as you pull back inside of that bar, it's an opportunity. It creates a zone that you want to be a buyer. Call it the gift zone. It's a simple retracement strategy. You can pick it on a higher time frame, but the idea is that you don't chase the top corner of this thing. You don't. You can start your trade there, but you don't want to be fearful of the knee bend. Just like anything in sports, um, just like anything in life, really, you have to go down a lot of times before you go up. You gotta bend your knees before you leap. Pick your sports analogy. So you want to be able you want to be comfortable in negative territory and add, where most people do the opposite. They get nervous when they see red on their screen, and they want to chase the market when they're up. It's the opposite, right? It is simple, but it's not easy because the emotions involved, and a lot of you just have bad habits. So we bought into this. I mean, there was lots of opportunities to buy into this, take some off, add back again here on the 1 minute, on the 1 minute. I think we took again right into this high, and then I bought into this 1 minute dip to finish off the afternoon. Um, let me let me show some of the execution. There's probably one, two, three, four, five, six, seven ads on initial one or two lot. All right. And then here on the Russell, you can kind of see the contrarian trading. So you can see how the back end, the trades at the end are actually losers, but they're smaller relative to what I was making on the NASDAQ. Right. And that's what's nice about a pairs trade is, yeah, they don't always go up at the same time, but 90% of the time, you're obviously going to see the Dow, the NASDAQ, the S&P, the Russell, they're all going to move together. So this is me short early in the day, adding, got a little bit off sides right here. This was my first cover, but then covering into that low I mentioned earlier. Bounce back up, reshort again, cover, cover. And this is where I reshort, but then we start to take off, and this is where that picture changed on the NASDAQ. And so I took one more shot on the short side, covered that, and then I started getting out of my exposure here and here. So what went from maybe up 500, $400-500 early in the day on the Russell. Hope you guys can see this. Maybe gave back 300 on this move, right? But then you can see, look, I started with $500 risk and ended up doing 3 times that, and 5 times what I was short over here. And that's just a matter of noticing where the trend is changing, and then learning to work your position size. Yeah, I wish we would have stayed long one the rest of the day. The days when it just rallies all day like this, you kind of think, all right. I mean, it's always a trade-off. You have other stuff to do. You don't want to trade through lunch. You don't have to catch every single move. That's kind of a fallacy that a lot of guys have with day trading. You can be more consistent, just getting in, getting out, not having the risk on. That's how you consistently pull money out of the market. You guys try to trade every move. That's the frustrating way to give back a nice morning. Uh, it's not necessary. Now, when you learn, another aspect of what we do a lot is learning to work a, a break even so that you can play with, the house's money. I don't like using the gambling terms a lot because trading and gambling is completely, if you do it right, they're completely different. The odds are different. You can stack the favors different, the edges are different. But as far as probabilities and managing your risk, uh, that analogy works when if you take a big chunk out of the market here, you say, all right, I'm going to buy on this next cycle. I buy well, I only risk a little bit. And then let's see if this thing continues the rest of the day and I'll add to it, bring up my average, pullbacks again, I add again, brings up my average. And then you just keep what they call break even stop and you just ride this until, you get taken out. Um, but the thing is, you only risk a small amount, you parlay it, you can add to it. And again, you try to do the same thing. You're going to take home $1,600 on this play, for example, like today. Maybe you risk another 200. You're not going to risk more than that. It goes in your favor. You add to it. You add it. Maybe you take another $1,000 out on $2,000 on this run. You start with 200 and you pull. I mean, this was a big move. This move is almost bigger than this move this morning. So you start with $200-300. You add a couple times, you could easily made another grand, 1,500 here. So that's what we mean by this is how you got to learn to manage your risk, guys. This may seem like a lot. Hopefully, I try to break it down simply. But when you start to get that okay, I can work into my position, but it's not bury yourself, average in all the way down forever, because that's how you're gonna have your biggest losers. It's working into the position within the area that your edges are, and then being able to add to it, managing your break even, managing your trailing stop. But the big key and the big aha moment for me and throughout my career was all the big traders are adders. And you want to get outside of this doing 1-for-2 risk reward ratio. That's why a lot of guys' P&L curve is flat, because it's like if you win 6 times out of 10, you lose 4, and you're 1-for-1 or 2-for-1, you're gonna have one of those that's poor in there. And if you don't have a big winner, then you don't really move your equity curve. But if you get down this concept of taking a certain amount of risk, if it starts to work, adding, and then occasionally you have a day like today, or you have something that trends, and you start to learn to catch the cycles, and when you might get a turn, so then you just exit or tighten up your risk. Anyway, long video. I think that's enough for me today. I will. Just because I said I would. So the difference between there's lots of different cycles. Like if you want to look at data, if you have a sample set, and you can put it in a computer and gather all the data. You can run cycles from that data. All right. You can look at a data set and attach equations of motion to it, which is a lot. There's different equations of motion. It's the physics terms. I talk about this all in our model. This is what my direction model is based on: physics, a lot of physics, energy, wave formation, vibration, fractals. This is all how energy and just how things move. So everything's cyclical, and then there's always a time component to this reality that we live in. So in this metaphysical time, things oscillate through time. So an oscillator, or is again equation of motion, we use certain parameters on the stochastic for that I've found that, it just does a great job. most of these lows came at the bottom of the cycle. All right, you guys see that from my videos. And then the pi cycle fluctuates around time, but it's shown on a visual on the chart. But the key on how we use that is we have cycles and price that move away from the average or the pi line, and then moves back to it. So we have oscillators going. You can have fixed sine waves. You can have a cyclical sine wave that's based on something like GDP, where you're just measuring the rates of change. You could also just have a fixed count, which is what I refer to when I usually do sine waves, which is you count, like, for example, the business cycle is 8.6 years. So it's a 8.6 rhythm with 4 years, peak to peak, trough to trough, right? And then there's an 8.6 frequency is a derivative of pi. Pi is a perfect circle. You see a lot of 8.6 counts. You can count candles. We do that cyclically a lot. You could do that on a 5-minute chart. You can do that on a weekly chart. That's it. I mean, if you guys want to learn more, I mean, there's a 9-hour course I do on our model, and it's 10 years of me trading institutionally, running rates desks, trading Forex, global macro stuff, but talking to all the primary dealers. We covered all the biggest of the big and fixed income and banks and hedge funds and buy side guys. So that's what we did. Very directional. That's what guys pay us for, and we help them with their timing. Anyway, there's a lot to it. I hope that helps for those of you who kind of had questions about that on the cycles. But I'm beat, guys. Hopefully you got some value out of this video. I will get some rest. We'll be back at it tomorrow to trade, and then I'll hit on the global macro picture. I think bonds are at a big place. I think there's going to be some opportunities to maybe allocate the setup into the first part of the year. So we'll talk about that. I'll do a video. All right, guys, enjoy your evening.